afford to die. I'd lose too much money. This quote from comedian George Burns may have been spoken in jest, but with inheritance tax rates currently at 40%, it's easy to see where he was coming from. But on a serious note, if you're keen to ensure that your loved ones benefit from your legacy, it's worth considering how you can minimise the impact of inheritance tax. Contrary to popular belief, inheritance tax, or IHT, doesn't just affect the wealthy or apply only when someone dies. While it can, of course, apply to your estate when you die, IHT liability can also occur during your lifetime. The good news is, proper tax planning can reduce the IHT payable for both events. When someone dies, IHT is payable if the value of their estate exceeds £325,000, which is known as the nil rate band. Additionally, a further nil rate band of £175,000 applies if the estate includes a property occupied as a home. So whilst this additional banding certainly improves the position, many estates are still caught in the IHT trap. IHT liability also applies to some types of transactions made while you're alive. These are known as lifetime-only transfers and include assets sold at less than their market value and certain gifts of money, property or possessions. But the good news is there are some exemptions to these lifetime-only transfers. These include an annual exemption for transfers of capital up to £3,000 per year, a small gifts exemption for gifts up to £250 to any one person, normal expenditure out of income, gifts made in consideration of marriage, and any gifts made to a spouse. Another piece of IHT jargon to be aware of is transfers both in lifetime and on death. And again, there are a number of circumstances where IHT does not apply here too. For example, expenditure for family maintenance. Most people are aware that paying for maintenance of a spouse does not incur IHT. But did you know this also applies following a divorce and for the maintenance, education or training of your children and the care of other dependents too? This can be enormously beneficial to families and should be considered in detail when planning your estate. So we've outlined some of the basics, but if you don't want to get caught out by inheritance tax, it's important to know which events and transactions trigger IHT, how it's calculated, what it applies to, and most importantly, what you can do to minimise or avoid it. It's certainly a complex subject, and as accountants, that's where we come in. At Palmer's Business Support, we work with you to develop a clear IHT strategy tailored to maximise your legacy. Please get in touch, because with our expert guidance, you can legitimately shelter you and your family's hard-earned wealth from the taxman.